Arista Networks is a leading supplier of network solutions that took a different approach to enterprise network management. Traditional networks offer limited scalability, limited automation capabilities, and require significant manual intervention. And they are more rigid and fixed in their architecture, which makes it a much more difficult and cost-prohibitive to modify or adapt to changing business needs. The legacy approach is no longer adequate for the management of networks of cloud or generative AI applications, or to handle the ever-increasing number of connections to the network as a result of the push towards the Internet of Things and remote work. This is where software-defined networking comes in, and Arista's high-performance hardware paired with its open and programmable software has taken advantage of the gaps in traditional networking. Given that Arista leverages a Linux-based operating system, which is open, their approach allows for much better programmability and scalability because new products and services can be added when needed and with little hassle. Arista's value proposition appeals to a large portion of the network management market, but it specifically appeals to large-scale cloud companies, cloud service providers, internet service providers, and next-generation data centers and campuses involved in AI and other next-generation technology because it increases network speeds and it drives down the cost of managing a network. According to this Forbes article, a typical legacy network requires one administration staff for every 1,000 servers. Out of the box, the Arista solution provides a 10-fold improvement. It's programmatic, automated, and can be scaled to millions of users. The company says clients have noted a cost savings of 10 to 40x, which explains why their growth has been off the charts. Besides its immense value proposition and its software-led approach, which creates product differentiation, Arista enjoys a competitive advantage versus potential customers due to what is called switching costs. These are costs that an existing Arista customer would incur if they decided to switch to one of Arista's competitors for its network solutions. Arista's proprietary software and hardware configurations require training and certifications, which can require weeks of class, hours of testing, and tens of thousands of dollars in expense. Furthermore, networking setups take months to implement and years to optimize. If a company were to switch away from Arista, it would require wholesale retraining of its workforce under a new vendor, inclusive of the time and expense to do so. Now that we understand Arista's business model and their competitive advantages, and both are quite compelling given the AI backdrop and Arista's value proposition, let's take a high-level look at their financials to determine if this company is worth further investigation. Arista offers a 2% free cash flow yield, which is significantly lower than I'd like. I usually want something in the range of 3 to 4%. Their 36 forward PE is in line with their 10-year average PE. Their 49 price to free cash flow is much higher than its 10-year average of 40. And at 14 times sales and 12 times book, they're quite a bit more expensive than they have historically been based on these metrics. In other words, this stock is expensive. With the stock up 42% year to date and 451% over the past 5 years, you would be buying in at an extremely high price. One of my main investing rules is that success comes with patience. There's a lot of excitement in the stock market for Arista's AI growth potential, but you have to realize that most stocks are going to go through a dip in any given year. If we take a look at Arista's price to earnings low for each of the past 10 years, we see that 9 out of the last 10 years, Arista's PE has dipped into the low 20s or even lower at some point each of those 9 years. I show you this because if history is any guide, there will be a better opportunity to buy this stock in the next 6 to 18 months. Revenue and EPS growth is stellar, with little to no seasonality or cyclicality. Arista's primary growth drivers include AI, digital transformation, and cybersecurity, which explains why their revenue is growing so quickly and why their stock is up 42% year to date, 412% over the past 5 years, and 1,937% over the past 10 years. Free cash flow has been choppy over the past 10 years. If we look at the growth ending in 2020, 2021, or 2022, the growth rate would not look good at all. There is no problem with cash generation with this company, but the large inventory requirements, a massive research and development budget, and their customers' heavy reliance on accounts receivable often consume a considerable amount of Arista's free cash flow. They carry no debt and have a good amount of cash. They don't pay a dividend, and shares outstanding are flat, so they're not returning much to shareholders on a net basis. Once we dig into the cash flow statement, you'll see that buybacks have only been about $1 billion over the past 3 years, and their buyback program is not enough to make a meaningful dent in the 317 million shares outstanding. Again, quite disappointing given the profitability of this company. Investors in this company are relying heavily on the company's intelligent reinvestment back into the company for returns. This is not necessarily a bad thing if Arista's growth rates continue as expected. Arista is highly profitable with a 10-year average return on invested capital of 20%. This is good, but not great. Margins are good and increasing, which is exactly what I want to see. The rising margins clearly demonstrate operating leverage in Arista's business model. One of the aspects of their business model which supports such high and increasing profitability is their use of what is referred to as merchant silicon. Merchant silicon is simply standardized semiconductor chips produced by third-party manufacturers designed for the use in network equipment. Other than the flexibility, performance, and scalability benefits that this approach offers, it helps reduce costs, which drives higher margins due to reduced vendor lock-in and the fact that Arista doesn't have to carry all the headcount, equipment, and R&D costs that would come with developing the chips in-house. This high-level review clearly demonstrates Arista's worthiness as a long-term investment. It's time to dig a little deeper into their financials and really understand how they run their business. We start off with the income statement. Arista's revenue has increased by $3.4 billion over the past 5 years, which outpaced the doubling of their operating expenses over the same period. This has led to the tremendous growth in their operating income and the expanding margins that we just saw in Qualtrim. Their largest costs are the cost of revenue, which consists of inventory, including the merchant silicon that they use in their chips, and all the costs associated with the manufacturing of their products. While their second largest expense is personnel costs, which consists of wages, benefits, bonuses, sales commissions, and stock-based compensation. The personnel costs are embedded in each of the respective line items that you see here on their income statement, with research and development being the second largest line item at 14.6% of revenue. Given the nature of their business, research and development and sales and marketing personnel costs are expected to drive increasing expenses over the foreseeable future right after the cost of goods sold. Arista has a very conservative balance sheet. Total assets have increased by $5.7 billion over the past 5 years, driven primarily by cash and short-term investments, inventory, and accounts receivable, while liabilities have increased only $1.5 billion, driven by increases in account payable and deferred revenue charges. Due to Arista's business model, they have a considerable amount of what they refer to as post-contract services, which are services such as technical support, repairs, bug fixes, patches, and upgrades. Customers pay for these contracts up front, so Arista has to defer the revenue recognition and the cost of the corresponding work to be done as deferred revenue, which is a liability on their balance sheet. With asset growth considerably outpacing liability growth, Arista's equity has increased by $4.3 billion over the past 5 years. This is a compound annual growth rate of 20% per year, which is tremendous growth and one of the reasons this stock has done so well. One thing I always pay attention to is the other forms of debt that a company has, such as lease liabilities, accrued expenses, customer advances, and other liabilities that are exactly that, liabilities or debt that will eventually have to be repaid. I want to stop right here to talk about how debt is represented in the financials of companies across the investment world. The focus of the investment industry is always on long-term debt, while other types of debt are ignored. When analyzing a company, I like to calculate their debt-to-equity ratio, including those other forms of debt, because I feel it gives me another perspective on the company's future obligations. For Arista, that percentage comes out to be 18%, which is still incredibly low, confirming that debt is not a problem whatsoever for Arista. Just like their balance sheet, Arista's cash flow statement is very straightforward and conservatively managed. Net income is the overwhelming driver of cash from operating activities, which is what I expect from every company, offset by inventories and accounts receivable, which goes hand in hand with their business model and the types of products and services that they sell. In the investing activities section, it's the purchase of more investments than that which matures, plus the acquisition of businesses that consumes the most cash. While in the financing activities section, it's the repurchase of their stock that eats up most of their cash. In summary, Arista manages their company quite conservatively while reinvesting most of their cash flow back into the business to drive market share gains and revenue growth. The next step is to compare Arista to its competitors. When we compare to their direct competitors, we see that they are much more expensive than their peers on nearly every single valuation metrics, all because they're much more profitable, they have little debt, and most importantly for their stock price, they're growing at a significantly higher rate, and this growth rate is expected to continue at 14% over the next year. As we discussed earlier, Arista does not pay a dividend like their competitors do. They don't buy back nearly as much of their stock either. Why do you think that is? You're spot on if you pointed to their growth rate. They're still growing fast enough that reinvesting their cash back into the business offers the best return on their money. This is in stark contrast to their competitors who are barely growing, if at all. And here's one of the more important metrics after the net profit margin and return on invested capital, and that is the cash flow margin. They're destroying their competition in the percent of sales that are converted to actual cash, and they have been for the past 5 years at least. It's time to consider the risks involved with owning Arista. Network management is a highly competitive market with some very reputable players such as Cisco, Dell, Juniper Networks, and Hewlett-Packard. Arista's sales are concentrated in the cloud networking market, which can exhibit cyclicality and lumpy spending patterns from customers. This lumpiness can be exacerbated by Arista's concentration in customers like Microsoft, which accounts for 18% of their sales, and Meta Platforms, which accounts for 21% of their sales. Combined, Microsoft and Meta made up approximately 40% of their sales in 2022 and 2023 versus less than 25% in 2021. In fact, you see this dip right here in Arista sales in 2019 and 2020. This is due to Meta skipping an upgrade cycle. Because of this dependency on Microsoft and Meta, they know that they have bargaining power with Arista due to the fact that they account for a large percentage of their revenue. They could require more favorable contract terms, which would impact Arista's profitability. Arista expects this level of revenue concentration to continue for the foreseeable future. Another risk is that their sales are concentrated with 79% of sales coming from the Americas. I'm surprised that they only derive 9% of their sales from Arista given their cloud-based approach and its general improvements for AI applications versus traditional network management. This concentration of sales can be viewed as a risk, but can also be viewed as an international expansion opportunity, which is why it doesn't bother me too much. Another risk is that they use merchant silicon chips, which we discussed earlier as being a performance and cost advantage versus competitors that produce their own chips for their network equipment. However, it also comes with the risk that they are controlled to a large extent by a few players in the chip industry, which can lead to supply chain risks and the possibility that the providers flex their pricing power with Arista, thereby resulting in higher costs per unit and lower margins. And this final risk is one that I feel most people are looking past due to the AI hype that we're experiencing at the moment, but I've been thinking a lot about it over the past few weeks. The market for AI applications is new, and Arista's customers are continuing to evaluate their opportunity in this market. If the AI market does not develop as anticipated, then the potential demand for AI Ethernet switches may not be realized. Lastly, if history is any indication, there is a real possibility that we get a tech crash 2.0 similar to what we saw with the internet revolution. Everything got so hyped back in the 1990s that internet-related stocks soared for several years before crashing in early 2000s. The most relevant example is a player in this network management industry, Cisco. Cisco jumped up to $79 in 2000. It has never regained that price again and currently trades at $47. In other words, if you bought at $79, you'd still be down about 45% 24 years later. I know we want to believe that AI is a game changer and is revolutionary, and there will be certain aspects of this technology that will become that important. But there's a very real possibility, and I dare say near certainty, that there are some stocks that are priced highly right now due to the potential benefits from AI that will crash and never come back, just like Cisco has. The final consideration in any stock is valuation. Morningstar values them at $270 a share, while CFRA's fair value estimate comes in at $282 per share. As always, I run my own discounted cash flow model, which values them at $280 per share, but with a 20% margin of safety baked in, I'd only be willing to pay $224 per share, which is a 32% drop from current levels. And there you have it, a deep dive into Arista Networks. Let me know your thoughts about the company and this video in the comments below. If there are any other companies you'd like me to take a look at, feel free to leave them in the comments as well, and I will eventually get around to them. Lastly, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable.